Ladies and gentlemen, before we talk about gold, let me ask you something more important. If your currency quietly loses purchasing power every single year and you do nothing, what exactly are you doing? You are participating in a system you don't fully examine. Now, I am not here to scare you. Fear is not useful. What is useful is arithmetic. So let's start with arithmetic. If inflation averages 3%, your purchasing power halves in about 24 years. At 4%, it halves in about 18. That is not collapse. That is erosion. And erosion is more dangerous than collapse. Collapse is obvious. Erosion is tolerated. Now, the question for 2026 is not whether the system will collapse tomorrow. The question is whether the incentives favor continued currency expansion. If incentives favor expansion, then dilution is likely. If dilution is likely, then the rational investor asks, should I own something that cannot be printed? That brings us to gold. Now, let me disappoint half of you immediately. Gold is not a wealth-building asset in the same way productive businesses are. Gold does not generate cash flow. It does not innovate. It does not compound earnings. Gold sits there, and yet gold has survived every currency system ever created. That is not an accident. It is not because gold is magical. It is because gold does not depend on trust and a promise. Every financial asset you own, a stock, a bond, a bank deposit, depends on someone else honoring a claim. Gold does not. Now, before you run out and buy a truckload of gold coins, slow down. The rational question is not, is gold good? The rational question is, under what conditions does gold make sense? Let us think through 2026. Governments are carrying historically high debt burdens. Entitlements continue expanding. Political systems reward spending today and postponing consequences. When debt burdens grow too large relative to output, there are only a few ways out. Raise taxes significantly, cut spending significantly, default openly, or reduce the real value of the debt quietly through inflation. Which of these options is politically easiest? Inflation. It spreads the pain slowly. It avoids headlines that say default. It allows politicians to maintain sub appearances. This does not mean hyperinflation. Hyperinflation is rare in advanced economies. What is common is steady debasement. Now, if that is the likely path, what happens to fixed claims? Bonds paying fixed coupons lose purchasing power. Cash sitting idle loses purchasing power. What happens to productive businesses? If they have pricing power, they adjust. What happens to gold? Gold tends to move when trust in currency declines. Not every year, not predictably quarter to quarter. But over long periods of monetary strain, gold reflects the strain. Now let us address the biggest mistake investors make with gold. They treat it like a growth stock. Gold is not there to outperform everything else. It is there to survive what everything else depends on. Insurance is not supposed to outperform your house. It is supposed to protect you if your house burns down. If you understand gold as insurance, you begin thinking fall purple Beaufort correctly. Now let's go deeper. Should you buy gold in 2026? The answer depends on three things: your current asset mix, your debt exposure, your psychological stability. If your entire net worth is tied to paper assets, stocks, bonds, bank deposits, you are fully dependent on institutional continuity. That may work perfectly fine. It has worked for long periods, but concentration risk is not rational. A modest allocation to something outside the financial system introduces robustness. 5 to 15% is sensible, not 50%, not zero. Moderation is rational. Now let's talk about physical gold versus paper gold. This is important. If you buy a gold ETF, you own a financial claim on gold. It is convenient, it is liquid, but it still depends on institutions. If your reason for owning gold is systemic insurance, then owning it through a structure dependent on the system defeats the purpose. Physical gold, bars, or recognized coins removes counterparty risk, but physical gold introduces storage risk. You must secure it, you must insure it, you must avoid telling the world about it. This is not glamorous, it is structural thinking. Now let's consider an objection. Gold produces no income. Why not just own great businesses? That is an excellent question. In fact, over very long periods, productive businesses outperform gold. Because businesses compound, gold preserves. If you had to choose only one asset for long-term growth, gold would not be first. But the world is not binary. You do not choose between fire insurance and productive assets. You hold both in rational proportion. Now let us analyze current conditions more carefully. In 2026, central banks face conflicting pressures. On one hand, inflation must be controlled. On the other hand, economic growth must be sustained. On the third hand, and politicians rarely admit this, debt servicing must remain manageable. Higher rates increase debt servicing costs. Lower rates risk inflation. This tension rarely resolves cleanly. Over time, financial repression often emerges. Financial repression means maintaining interest rates below inflation. This quietly reduces real debt burdens. When real yields are negative for extended periods, gold becomes more attractive because the opportunity cost of holding gold declines. If cash earns less than inflation, gold's zero yield is less of a disadvantage. Now let us examine volatility. Gold is volatile. It can fall 20% or more in a year. If you cannot tolerate volatility, you should not own it. Gold is not a straight line. It is a hedge that moves in waves. The mistake is expecting immediate confirmation. Insurance only feels valuable when something goes wrong. Now let us address something uncomfortable. Many people want to buy gold because they are afraid. Fear is a poor basis for allocation. Structure is better. If you decide rationally that systemic risk is non-zero and currency debasement is probable over decades, then a modest gold allocation is justified. If you are buying because a headline scared you yesterday, you are speculating emotionally. Now let us compare gold to other inflation hedges. Real estate can hedge inflation, but real estate is leveraged and illiquid. Stocks with pricing power hedge inflation, but stocks are still embedded in financial markets. Commodities can hedge inflation, but commodities are cyclical and volatile. Gold is unique because it is monetary. It is not primarily consumed. It sits as stored value. That characteristic gives it durability. Now let us consider timing. Should you wait for a crisis before buying gold? If you buy insurance after the fire starts, premiums are high. Gold often spikes during crises. Buying modestly during calm periods is more rational. Not aggressively, not dramatically, gradually. Now let us address the argument that gold underperforms over decades. Yes, compared to equities, gold has historically underperformed in real terms. That is because equities represent productive capacity. But gold's job is not to outperform equities. It is to protect against equity vulnerability during systemic stress. Think in portfolios, not in isolation. Now let us examine risk of overallocation. If you allocate 40% or 50% to gold, you are making a macro bet. You are betting heavily on monetary failure. That is speculation. Rational investing avoids concentrated macro speculation. 5 to 15% is insurance. Beyond that, you are predicting collapse. Prediction is fragile. Structure is durable. Now let us look at personal situations. If you carry high-interest debt, buying gold before eliminating that debt is irrational. Paying off a 10% interest obligation is a guaranteed return. Gold provides no guaranteed return. Clear liabilities before buying insurance against systemic risk. If you have unstable income or minimal savings, focus first on emergency liquidity. Gold does not replace liquidity. Liquidity pays bills. Gold preserves value. Different functions. Now let us discuss storage psychology. Owning physical gold changes your perception of wealth. It becomes tangible. That tangibility can reduce panic during market turmoil. There is psychological value in knowing part of your wealth exists outside electronic systems. Psychology matters. Now I want to address the possibility that nothing dramatic happens. What if 2026 passes quietly? What if inflation moderates? What if currencies remain stable? In that case, gold may stagnate, and that is acceptable, because insurance that never pays out is not a mistake. Now let us zoom out even further. The greatest risk to investors is not inflation, it is behavior. If you panic sell equities during downturns, gold will not save you. If you over-leverage in real estate, gold will not save you. If you speculate wildly in pursuit of excitement, gold will not compensate for poor discipline. Gold is a supplement to rational behavior, not a substitute for it. Now I will simplify this into a clear answer. Should you buy gold in 2026 if you have no excessive debt, adequate liquidity, a diversified portfolio of productive assets, and you desire insurance against systemic risk? Then yes, a modest allocation is rational. If you are seeking high returns, rapid gains, or dramatic protection from every downturn, then no, gold will disappoint you. Gold rewards patience, not excitement. Now let me leave you with something more fundamental. The goal of investing is not to win every year. The goal is to survive every year. Survival allows compounding. Compounding creates wealth. Gold contributes to survival in specific scenarios. It does not create wealth by itself. It preserves optionality. In a world where debt burdens are high and incentives favor gradual debasement, owning something that cannot be printed is not irrational. It is structural thinking. Do not exaggerate it. Do not romanticize it. Do not ignore it. Allocate modestly, hold patiently, focus primarily on productive enterprises. Maintain liquidity, limit leverage, control expenses, and let arithmetic work in your favor. If you structure your life and capital rationally, you will not need to predict 2026. You will be prepared for whatever it becomes. That is the rational answer. And rational answers are usually less dramatic than headlines, but they endure longer. Thank you.